The Hull moving average was created to address the problem of lagging that comes with other moving average types. For example, I am now running both the 20 length Hull moving average and the 20 length simple moving average on this chart, and I want to zoom in and focus specifically on this move here. Notice how when this stock begins to make this move down, the Hull moving average, being this cyan / purple colored line, captures that move, whereas the 20 length simple moving average is still going up during that move. So the Hull moving average is much faster reacting to the movement of the underlying ticker. It does so by utilizing the following formula. Don't worry, I don't understand this either. In more layman's terms, the Hull moving average is able to eliminate the lagging effect by utilizing a combination of two weighted moving averages with different lengths. First one equal to the period of the Hull moving average, second equal to the half period. Then there is also a smoothing effect attained by applying weighting moving averages to the result. And that's all fine and dandy, but all any of us really care about is, can we use it to make money? That's what we're going to figure out in today's video. Welcome back to the Exploring Indicator series. If you are new to this channel, in this series, I attempt to make profitable trading strategies around just one indicator. We do this so that we can isolate the parameters of this indicator and figure out the best way to utilize it to make us money. The first thing that caught my eye about the Hull moving average, and probably a lot of you watching this video as well, is it does this cool thing where it changes colors whether it is moving up or down. Now we're going to cover multiple different strategies in this video, so stick around. But of course, the first strategy idea that came to my mind is buy when the Hull moving average crosses from moving down to up, and sell when the vice versa happens, when the Hull moving average crosses from moving up to moving down. As we scroll out on this chart here, you can see I have this running on the daily chart for Nvidia, and we'll look at some other tickers and some other time frames, but I also have the floating P&L study running here at the bottom of the chart, which of course shows the profit loss of the strategy, and I have my custom built backtest label statistics that are showing you the backtested statistics of the strategy as well. As you can probably tell, the numbers on Nvidia look really good. Made over $160,000, only a 42% win rate, but the average win is over $3,000, whereas the average loss is only $1,400. So it does a very good job of holding on to its winners while cutting its losers quickly, which makes it profitable on even a win percentage less than 50%. And its max drawdown percentage, which is an extremely important number in backtesting, is only at 13%. That means the difference from the peak in profits to the lowest low that this strategy has been is only a difference of 13%. That is not bad at all. I really consider anything under 30% to be fine and to likely translate well into live trading. But of course, we're looking at Nvidia. Like, yeah, Trey, I could close my eyes, hit buy, and make a ton of money on this ticker. You're not wrong. So let's look at some other tickers. Let's go look at the S&P 500 index, which of course is a very important one to test against. This one, really bad, right? But Trey, it makes money. How can it be bad? Max drawdown percentage, 211%. Oh, but Trey, the back test is green. No, that is way too high of a max drawdown percentage. I would never try to utilize this strategy in the live trading markets. Another ticker I like to look at a lot is XYZ, just because this ticker has a little bit of everything, right? It's got consolidation, big move up, big move down, followed by some more consolidation. Once again, profitable. Yay, yippee, right? Woo, it makes money. But once again, the max drawdown percentage, way too high. Max drawdown of 75% is way too high, and the strategy is very unlikely to translate well from backtesting to real world trading, which is what actually matters, right? Who cares if your backtest makes a ton of money? That means just about nothing, right? It needs to be able to actually translate to live trading, which is why this max drawdown percentage is so dang important. But I haven't touched the parameters of the Hull moving average study at all yet. We are still running on that default length of 20. So what I'm going to do is I'm going to come in and I'm going to change the length that my strategy is running off of from 20, and let's bump it up to 100. Let's try a much larger length. I'm also going to change the length in my whole moving average study just so the visualization matches. Let's go ahead and run this now on XYZ. Keep an eye on this most important statistic being max drawdown percentage. As we run this, hey, okay, the max drawdown percentage comes all the way down to only now 24%. That is way better. And remember, I said anything under 30% is something that I am happy with. A back test that I would be happy moving forward to forward testing, right? Let's go ahead and take a look back at SPY, which if you remember was at like a very high max draw. It was like 200% or something before, right? Now it is only at 27%. Much nicer. And of course, we can look at NVIDIA again. But again, NVIDIA is NVIDIA. The max drawdown percentage actually even gets better here. It is now in the single digits at only 7%. So it seems like raising the length of the whole moving average study makes it more useful. Now, of course, you're going to be in trades for longer. Your average holds are going to be longer than they were before. But like, do you care? Do you really care, right? If you're in a trade and it's making you money, why are you in a rush to get out of that trade? That is something I really just want to hammer in. Sorry, that might have peaked the mic. Sorry. I want to hammer that into beginner traders' heads so badly. It is very okay to hold a stock. If it's making you money, hold the damn stock. Anyway, raising the length of the whole moving average seems to be sort of the first thing that we've discovered to help make this moving average study work even better. Now, a very important ThinkorSwim feature on top of being able to build custom codes in this way is that the custom codes will run on, as you've already seen, any chart, but also on any time frame. If we jump down into the 5-minute time frame for NVIDIA here, you can see the statistics and the strategy itself automatically updates to the candles on this time frame, which is just super nice. You don't have to go in and edit the code for every stock, every time frame, etc. Looking here at the NVIDIA 5-minute chart, we can see a way too high max drawdown percentage. I'm going to make an assumption, I don't know yet, that if we come to a shorter time frame, like let's come back down to the 20 whole moving average rather than the 200, that'll be a little bit better for day trading. Not really, right? Okay, we didn't land there. The max drawdown percentage is still way too high. What if we shorten it even more? Like what if we come down to 10 on the whole moving average length? And by the way, as I'm doing this, I want you to be taking note of how I'm testing, right? This is how I test to find if things work or they don't. Okay, that makes it even worse. So I don't know. I just did a very quick test there. I don't want to dive hours into this video, but it seems like the whole moving average maybe doesn't work so well on a 5-minute time frame. What if we hop out to something a little bit longer? What if we go to the 1-hour time frame? Okay, the max drawdown is at 40%. That is still not something I would want to move forward with, but maybe we can work from here. Let's go back from 10 to 20 on our whole moving average length. Let's see if that is any better. 35%. We're getting a little bit better, but okay. So I'm going to stop like sort of messing with things and just come to some sort of very early stage assumption here. It seems that the whole moving average is going to work better on larger time frames. Maybe you can use it to day trade, maybe like the 1-hour or 30-minute time frame, something like that. You would have to take this strategy yourself, fudge with the parameters within it like I am doing, and hopefully land on something that works for yourself. But I'm going to take the early conclusion here that the whole moving average is much better for swing trading than it is for day trading. And that might sound like, oh, well, that's a failure. This strategy sucks. The strategy doesn't work. That's not a failure. That's not bad, right? Understanding the weaknesses of a study is almost more important than understanding its strengths, right? Hey, let's not try to use this thing for day trading. Let's try to use this thing solely for swing trading. That's something very useful to understand so that you don't lose money trying to use an indicator that doesn't work. All right, so I've reset everything back to normal. We're back on the daily time frame. I have both the whole moving average study and strategy set back up to run against the 100 moving average length, as we have found that to be successful, right? But hey, we found success. Now let's see if we can find a way to make it even better. The moving average crossover strategy is the most popular strategy that exists. It's one of the ones that beginner traders learn first. Well, let's see if applying the same idea but to the whole moving average pays any dividends. So on this chart here now, I am running our 100 length whole moving average that we found in our first strategy test to be a very useful one for determining market direction. And I have also combined it with a whole moving average set to the moving average length of 50, being this orange and yellow line. Let's build a crossover strategy around these two average lengths. Here we go. I have now built that strategy and it is running on the chart behind my head here. As you can now see, when the shorter length whole moving average crosses above the longer length, our 100 length, it is entering the trade. When it crosses back below, it is exiting the trade. You actually get like a really nice comparative visualization here from the previous strategy in where the longer length is changing from that uptrend to that downtrend, which of course was the strategy before. It seems like this strategy is very typically entering slightly later. That's not a great example because it's super choppy. Let's go with this. It is typically entering slightly later, like the previous strategy we built would have entered on this candle right here, correct? Instead, we enter up here, but it is also getting out a little bit faster. The strategy before would have gotten out down here on this candle, whereas this strategy obviously gets out here. So looks like at a very early visualization level here, slightly later entrances with slightly earlier exits utilizing this strategy. On NVIDIA, our max drawdown is at 16%. And I will also make note that the win percentage is now 58%. So the win percentage has ticked up 10 or so percent from the first strategy. Let's once again go look at SPY, and our max drawdown is at 24%. That is workable. I would take this strategy and move forward with future testing it. And also, once again, win percentage is above 50%. That is nice to see. Let's go take a look at XYZ. Very nice. This is the crazy up and down and chop and all around stock that I like to use for back testing for all of those reasons. The max drawdown is only 14%. Once again, win percentage now at 58%. This strategy seems to be working just as well, if not maybe even a little bit better than the first strategy. And just to make you aware of a visualization that I myself just came across, because my next idea, as I'm sure a lot of you were also thinking, well, Trey, if this strategy has slightly worse entrances but better exits, then let's combine the two, right? Let's use the entrances from strategy 1 and the exits from strategy 2. But I am of course still running the moving average crossover strategy on the XYZ chart, where you're zoomed into some of the chop at the top here, and you will notice there are times where the exits are also worse. It seems like it's just a little bit of give and take between the strategies. For example, here you don't get out until all the way down here, whereas on the first strategy, you would have been out on this candle here. Same thing here, you don't get out until here, whereas on the first strategy, you would have been out earlier on this candle, holding through less of the dip. So the entrances and exits are not always better and or worse. It sort of, once again, just seems like that is the flow of each strategy and sort of a pro and con that is always going to come with any strategy that you build. I just need to pause here and let you know quickly that if you are interested in either one of these strategies or the custom backtest label study, they are available alongside over 150 other custom coded studies, strategies, and stock scanners that you can easily import into your ThinkorSwim application over on my website, daytradingstrategies.net. There is a link to the site in the description down below my video, and you can even access a handful of free ThinkorSwim codes right now just to get an idea of how easy they are to import and how useful they can be. So go check out the website, at least take advantage of the free codes, check out the reviews while you're there, and decide if it's something that can help accelerate your own personal trading journey. So I think both of the strategies we've made using the whole moving averages in this video have merit even as standalone strategies. I mean, the statistics that we've looked at on both of these strategies are pretty good. Now, we only looked at 3 stocks, so there's a lot more deeper back testing you will need to do once you import these strategies and run them, once again, alongside the custom back test data study so that you get immediate feedback on the statistics of said strategy. But I also want you to remember this. The point of this series is not typically to build standalone trading strategies, like not for you to take this strategy and to just go trade it blindly in the stock market, but we build the strategies so that you can get an idea of the most profitable way to make use of this single indicator. And we found that the strategies, once again, we built in today's video are powerful. Now consider what you may be able to build taking advantage of the ideas from this video and combining them with other rules that you have already found to be profitable that exist within your trading system. That's the point of all of this, correct? Anyway, if you did enjoy today's video, hit the like button. If you would like to continue learning, make sure you subscribe to the channel down below. And if you want to see more videos just like this, I will link the Exploring Indicators playlist here. Go check out the other videos that I've made going over individual indicators such as this and finding ways to make them the most profitable.